early, and that was, I had a downdraft, but it was not so drastical. I never got to the limits that are given in the guidelines.
Mm-hmm.
So even that, and then the pullback came, and I had a really great month. So, I mean, one month it will take you out for sure, but if it's within the guidelines, the 15%, that would be completely reasonable. If I had a 15% loss 1 month, that would be it. I'm prepared.
So is that an M3 that you're trading or something else?
No, I'm always trading. I did M3s, I did V condors, and I dropped all of that because I have the feeling I'm very experienced now with the bearish butterfly, and especially I have, when we go into not expiration, but let's say the 25 days to 7 days range, then I do have adjustment techniques that I kind of developed myself, and it follows the idea just to keep your delta small, but you just do. Sometimes I built a condor, for example, that's fairly wide, but still has a good risk-reward ratio and stuff like that. So just right now I have two of those condors on that. I have different accounts. That's another thing that I do. I trade in the same month. I trade parallel different butterflies. The starting time is changed. So I start some early and some later, and all of them are profitable. Doesn't matter. No? So I'm really amazed about this trade.
With the bearish butterfly, yeah, it's a good one.
Yeah. The bearish butterfly is probably the least affected by the option view issues. I think that most people are trading the M3, and that's the trade that's really affected the most.
Okay, the M3. Okay. Yeah, I see people talking a lot, and I know that John had a big issue. His December, he took a full loss in December on the bearish butterfly, and he says this is purely due to the problems with option view. He would have, and that's because he followed his rules, but with the new model in option view. So and they don't fit together.
Right. You know, the delta guidelines in the bearish butterfly are more generous, shall we say, than the M3. The tolerances in the M3 are much tighter.
Yes.
So the model is going to cause problems, you know, quicker.
Mm. Exactly. Yeah. So
I also think that one of the reasons why Dan Harvey's trade is getting so much attention right now is the fact that you don't really need option software to use the trade. You can do that entire trade without looking at the Greeks of the position. He did mention using the delta as a guideline for putting on the debit spreads when the market moves down, but you don't have to do that. You can just do it by where the market is inside the tent, and so that makes it very appealing right now not to have to worry about the model and to have a fairly appealing trade.
Mm-hmm. Yeah, sounds good. And this Dan Harvey's, I'm just not familiar with what you just said. He has a different type of trade, or
yeah, it's a broken wing. It's a bearishly positioned broken wing butterfly, and it's put on much earlier than most of John Locke's trades. He's putting the trade on about 70 days to expiration.
Ah, okay.
So you get a very flat T+0 line, and the trade can be managed with literally without looking at the Greeks at all. All you really need is an accurate P&L of the position.
Okay. Sounds interesting.
Yeah, I think Tom's going to do a presentation on that trade
Okay.
in the near future.
Wonderful. Wonderful.
Yeah, in fact, I talked to Dan Harvey, and he's going to see it, make sure everything's okay, and then I'll present it probably, I think the first roundtable in January.
Okay.
I see somebody is working a bid on a road trip in the first March weeklies in IB.
Okay.
There's a 65 bid for 6 of the 1930, 1980, 2020 put butterflies. So that's clearly one, somebody working his trade.
Yeah, I put a few on recently myself, so if you'd like, I can share them.
I'm sure there would, definitely be interest in that.
Did you guys see the huge call volume just before the Fed announcement in SPY?
I didn't see that.
So one person came in, a single order, and he put in $15 million worth of SPY calls.
Okay.
And the next 2 days, the market rallied big time. So I was just tracking those call prices. And if he sold the next day, he would have made a 10 million profit. And if he sold the day after that, it was close to a 30 million profit.
It's interesting that you use the SPY rather than the SPX too.
Yeah, I mean, maybe it was because of liquidity or whatever reasons, or maybe it's easier to hide your orders when you're doing it from SPY. Must be a really big player who did that.
Yeah, it's hard to predict. You don't really know what the person's got on. He could be hedging something else, or maybe it was closing something else he had open. It's hard to say.
So it was so remember, Tom, I told you like a couple of months ago, there's this person on Twitter called Wall Street Jesus.
Yes. Mm-hmm.
He's very good at reading order flows. So he called this out as an individual order by smart money. And he said it was not used for hedging anything, but it was just because there was some inside information floating around. And he's usually right about all this because he's a full-time day trader. And,
right.
If you actually take his opinions, you could make a lot of money, but you just have to, he probably posts his opinions about 10 minutes or so later than he actually puts on the trade. So, you could have lost the trade by then.
Tom and Andrew, this is Tom Henley. The only thing I've noticed putting these on is there's not a whole lot of OI. Not a whole lot of open interest at all. So I know that's why Dan says he lets it sit all day or tries to work it over a couple of days.
Yeah, here's the open interest and volume on SPX for this February week 4. And like you said, there's not a lot of volume on here in open interest. On the Feb monthly, of course, of it, but not on the weeklies. But that said, I haven't really found any execution problems, but I haven't been doing, 1,000 lots.
I mean, I would guess if you're doing, 6 or 12 or 18 of these things, it shouldn't be a problem. The weeklies are electronic, but there should be enough market making activity in there that you shouldn't have that much of a problem.
I've been waiting to get filled in an order since morning. I have the regular Feb expiration. I have a road trip I'm trying to fill. The short is at 1980. The longs are at 2020 and 1930. And I had the order in at about $1 debit, and now it's sitting at 1.15. And the prices are fluctuating anywhere between 1 and 1.35. I'm not getting filled, so try another day.
I'm just trade. Dan Harvey starts at like 5 points above, so you would do something like, let's do a 1 lot. and then 40 points below that, so you would sell 2, and then 50 points below that, so you would buy 1. And then that would make it look something like this. Very flat T plus 0 over a pretty large range. So the market can move quite a bit before you have to do anything. And Dan Harvey said, he'll let these sit a month before he does anything. And if you look on a price chart and do the birdie, see it's got a really nice profit zone. So over a large range. It's a very appealing trade. I put this lot on yesterday and didn't have any trouble getting filled. I don't know why. It was, I got it pretty much filled at the mid-price. I did let it sit for about an hour before it got filled, but it was not a problem to get it. And oops, I have to do both. It's only been on a day, but you can see it's there's nothing really to do with this trade right now. Just let it sit and bake off. Here's one standard deviation. So this has a 71% chance of making $1,400 on, what is that, about 16,000 of margin. I also did another trade, kind of an experimental one on ES, a road trip trade, just to see how the futures options would trade. We got to get the right account. Yep, there it is. Okay, so it seemed a little bit narrower, but the margin's much. So like a 12 lot on SPX would have about $12,000 in margin, but on the futures option, remember ES is $50 a point, so I would expect to double it. So I would expect it to have a $6,000 margin, but the span margin is only about a little over $2,000. And if you look at the yields, they're definitely higher. If you look over here, here's 70, 150, 360%. So it doesn't take much to turn with the futures option. You get a similar type of chart. But I'll let you know how it goes. But I'm trying to make the $600 to $1,000 on profit on this, but the margin is low. The yield is pretty high.
The futures margins are in effect like having portfolio margin, aren't they?
They are, yeah. So you don't have to have $100,000 to trade futures and get this kind of margin. Now that said, if the market does start moving down, then this line will start heading south, then their margin is going to start increasing. But at least initially in the trade, it's pretty low.
Now, I don't know how the liquidity is, but the options trade longer during the day too, right?
Yeah, that's right. This got filled at 1 in the morning, so it was, you have a better chance to get filled. Here's the volume. And there's no weekly margin or weekly options on the futures going out in SPX. I don't know how many others are SPX where you can go at 8 weeks. I had to do this cycle. It's not bad.
The only problem with the futures is that the commissions are very expensive, especially if you have to do a lot of adjustment.
Yeah, let's see, the commissions on here were here. So, yeah, about $1.50 a contract, something like that.
Really? That's what you pay for?
Yeah, so it wasn't too bad.
Really? That's very good commission.
Yeah, in fact, here's a 12-lot on ES, and then a 12-lot or 11-lot on SPX. So it's, I guess it's higher. I was looking at the wrong one, maybe.
What is the average commission people are paying in this forum at TD?
I don't know. I mean, I'm using Interactive Brokers, so I just use their standard rates.
Okay, so you pay $1.50 a contract?
Well, no, it's like for Russell, I think it's 70 cents a contract, minimum of $1 per order. So if you have two contracts, it'd be $1.40, but then you have to pay the exchange fee. So I think a Russell, let's see, here's a one lot on the Russell was $1.24, and a one lot on SPX was $1.53.
Yeah, I think TD Ameritrade doesn't charge you the exchange fees. So
Correct.
that-
Yeah, so if you can, you get like $1, $1.25, or something like that, then if you're not paying the exchange fees, you actually have a pretty good rate.
Right. Yeah, I have a fixed rate of $1 a contract.
Randy says Toss is doing exchange fees now.
Oh, really? I should start paying attention then.
Okay. Oh, on futures. Okay. Okay, so that's basically what the road trip trade is, and I'll keep you updated on the ES futures, how it trades. But, so far it looks pretty good.
I've got, I use Interactive Brokers too, and I have 97 cents as the option commission schedule, and that's usually pretty close to what I end up paying, unless it's a one lot. For some reason, the one lots are always at like $1.27, but the legs of the butterflies always work out to be just a little under $1.
But how about the exchange fees on the futures?
Oh, I don't. This is just Russell and SPX. I haven't traded futures options.
Right. That adds up, I think. That ends up being like double what you pay for the index. But I mean, if you don't make a lot of adjustments, it's not a big deal. But if you have to move things around,
It would be, the road trip trade would be a good candidate because there's not a lot of adjustments.
right.
Yeah, that's why I thought I'd give it a whirl, and we'll see how it goes, but it looks promising. I do like the fact that you can buy the underlying too, which is nice. I see Timo's here. Timo, have you done any work with the road trade beyond what we did in the questions to Dan Harvey?
Well, I'm in the car right now, so the connection is not really too good. I've started doing a little bit in TOS, but I'm still in the process of transferring to one, and once I have that done, then I'll commit to the back testing.
Gotcha.
But I'll make sure to keep everyone updated as soon as I have something, because so far I've been mostly on the taker side, and I want to go to the giver side as well.
Right.
Hi, Tom. Are you planning on hedging with the futures with the hedge on the down move?
Say again, Chuck?
You said that you had the option to use the futures. It seems like on this trade, the most likely thing you'll have to do to adjust is on the downside. So do you plan on using going short a future or two, or maybe some more time?
Yeah, I could if I need to. I mean, the effect of a future or a stock, the underlying is just to rotate the risk graph. So I guess I could just illustrate that if you're not familiar with it, have people watching. So if I have, I think this is it. Yeah, okay, so I have this trade on, and say it gets down here, and whatever my delta is, I want to decrease my delta. If I short a futures contract, that's rotating the whole risk graph to price. So you can see that. So if you need to get flat, it's fast and easy just to short a futures contract. The options, we do that, do the futures contract first just to flatten the T plus 0, and put the options and then take the futures contract off. That's one thing you could do if the market's moving quickly.
It sounds like it could be an easier hedge than buying debit spreads too.
There's no I mean, the only have is delta, no theta, gamma, vega, but that's also one thing you can do with SPX too. If you you can use SPY to make small changes on your SPX trades. So, for instance, like this is minus 4.5 delta. If I wanted to say be minus 10 delta, I could just sell 5 SPX, which is shorting 50 SPYs, and that gives you your minus delta one. So that's one way you can kind of tweak your risk graph, with your deltas if you want to rotate it a little.
You can also use SPY if you want to fine tune too.
Yeah, that's what I said. So if you want to add or subtract some delta on SPX, just 10x it and just many shares, and you've hedged your SPX. And Ron, yeah, this is typically only viable in PM accounts. It depends. I mean, if you're doing a butterfly and you have a big credit that you brought in, then there might be cash to use that for a tweak. But yeah, typically I would think a PM account would be better for that type of maneuver. And let's see. So Ron says the main index is synthetic. Yep, you could do a combo. I'll promote a few more people. Okay, so any other questions on the road trip trade? I know there's still a few outstanding questions in that forum thread, so I'll try and put them all together and send them off to Dan Harvey to get his 2 cents and post it back in the forum.
Hey, Tom, is there any update with regards to your presentation that you had planned?
Well, just that I have one planned, and I'm starting to put it together, and then I'll run it by Dan Harvey to get his input, and then I'll do the presentation. I don't know if Dan will be there or not, but I'll have an easy one, back test someone in a strong market up, and then a down market, just so we can see the difference and how it's adjusted.
Great. Yeah, looking forward to that. But that's going to be then in January, most likely, right?
Yeah, I think I got it scheduled for the January, what is it? January 6th.
Great.
If you're using option view in the road trip trade, I wonder if you would be better off using each individual option volatility model rather than the variable. I don't know, does Ron Bertino have any thoughts on that?
No, if Ron's called in. Oh, I think you are, Ron. Click on the quick start. You should see the call-in information. I guess Ron's calling in.
Tom, when you're going to do your adjustments, are you going to...
No, can you hear me?
It's going to be intraday adjustments, or
Okay.
are you going to do the back day?
Yeah, the update, I don't know if you guys saw the update from John Locke from yesterday, but what he's saying now is that in his opinion, the Tosfall Smile is the most accurate modeling available we have right now, right? Which is pretty much what I've been harping on about for the last few months. And he has now said that he no longer trusts the variable volatility model on the downside with option view. And he has now gotten to the point that he's literally like throwing it out the window because he doesn't trust it. And he's reverting back through to EIOIO. So that's, basically his current stance right now. So he's looking to potentially start even modifying the core recommendations of his main trades around the EIOIO model instead of variable, which means that EIOIO basically tends to, give you a worse downside than reality. So instead of adjusting like an M3 at 50 deltas, then you may need to adjust it at 75 kind of thing. But pretty messy. The easy thing, I guess, is you can maintain the standard guidelines of what John Locke teaches with delta limits and all that kind of stuff if you're using TOS-Vol-SMILE, which is what he's recommending as the best model right now.
For the road trip trade in particular, I think you would want to use the every individual option.
Look, the best thing to do, I guess, is the usual, right? To basically just test it and see what's more accurate. I've not found the individual implied vol to be very good in general for even for something like a broken wing. And I know that John Locke has kind of differentiated between the upside versus the downside, right? But on the downside, you'll definitely not get, and I'm just regurgitating what John Locke said yesterday, right? That he said on the downside, the variable volatility model in option view is not worth even looking at now, right? So TOS-Vol-SMILE is number one option if you have access to that. If you don't have access to TOS, he's recommending that you basically stick with EIO for now. But then you'll have to realize that the T+0 you're looking at is not going to be so-called accurate, and you may have to start compensating for that line, similar through to the kind of stuff that Jim Riggio was saying when he was showing the Kevlar, basically saying, that he just knows that the T+0 is slanted a little bit more, and he just compensates just because of experience.
The big problem right now is that TOS is really not useful when it comes to backtesting.
Okay, that's what everybody says, right? But there's two separate things, right? So basically one thing is saying, well, which graph is going to be giving you so-called accurate and reliable and consistent T+0s? And now John Locke is on board basically saying that is the model that you want to be using, right? I found the same. People that have been measuring this thing on a daily basis are all finding the same. So I think, I think we have consensus, right? That is the most accurate T+0 that you're going to be getting that's available to people right now, right? Now, so that's point number one, and hopefully, most people now agree that. The second thing then is basically saying, can you just get by with TOS and not use anything else? Well, the answer is no, right? If you want to do backtesting, you need a tool for that. TOS absolutely sucks for backtesting, both ThinkBack and
On demand.
On demand, yeah. On demand is potentially more viable from a functional perspective, but it's ridiculously slow and ineffective, right? So they're really just not viable options. So you really need either option view or, in my opinion, one, right? Use just the one beta, and that will give you a really good way to do backtesting in a reliable way, right?
You need software that's going to give you, number one, at least a semi-reliable model, and also that you can go and use that model to backtest.
Well, yeah. I mean, in an ideal scenario, sure. Okay, use one tool to do everything is the perfect scenario, right? Right now, we don't have a perfect scenario. So right now, the imperfect scenario is that the most accurate T+0 is TOS-Vol-SMILE, and then use something like the one beta or option view just to do backtesting to understand the mechanics of a trade. Even though you got to realize that if you're using option view with EIOIO, then the delta limits that you'll be using are not going to be so-called accurate. Right. So, I mean, based on that, personally, I don't think that the EOIO model is very good at all. Right. And as a matter of fact, the OptionView people, pretty much everybody at OptionView will tell you the same thing. Right. That model is extremely simplistic, does not give you accurate lines. And this is coming from the company that made the product. Right. So I think that's a pretty big clue that it's probably not a great idea to use that model. So, you know, of course, they're not going to be recommend that you go to a different product, but I don't have that conflict, right? My recommendation, switch to one, use the one beta to do your backtesting. That will give you very close, accurate results, similar to the old style of OptionView. Do your backtesting there. You know, John himself is basically saying the variable model is not reliable now, right? And then the OptionView people is telling you that EOIO is not reliable. Right? So put those two things together. You don't have much of a choice, in my opinion.
So Ron, just to clarify, you're saying backtest in one, and when we are backtesting, do we turn on the CEV and the wall surface option?
All right, my recommendation is to do your backtesting in one, but the one beta, right? Not the standard release, because the standard release doesn't have the new option modeling in it.
Right.
Okay. When you do that, the way that the latest beta works now is that Andy has basically configured it to try and remove complexity from all the different options, blah, blah, blah. So he wants the software to basically make those choices on your behalf, which are, in his opinion, the most accurate, right? So basically, you don't need to worry about anything. You just leave the defaults that are on there with beta, which basically means that everything is turned on, and go with that. And I think you'll find that the modeling there is quite good, right, for doing backtesting, right? But again, then when it comes through to you managing your live positions, my recommendation would be to do both, right? So basically, you do toss, vol, smile to manage your Greeks for your live position, and that is your authoritative view of your Greeks, right? Remember, the P&L won't be accurate there, but if you either switch to individual implied volatility in toss, or what I'd suggest is that you export your trades from toss that have been filled and import those into one, and then you run those side by side, right? So now you have toss, vol, smile that you just leave on toss, vol, smile all the time in toss, and then when you're looking at your other screen for your trades, then you're seeing your live trades being tracked in one as well. And with the way that one works, that actually shows you a really good T+0 now with the beta, but at the same time, you actually get to see your real P&L as if you had switched the model in toss to individual implied vol to give you an accurate P&L, right? So on one screen, you've got one beta running with your live position, and you can see your accurate P&L at the same time. And then on your other screen, you've got toss, vol, smile, which is going to give you the most authoritative view of your Greeks. That's how I'm trading, and I think that's the best setup right now.
All right. So sorry, I'm just a little confused. I thought that in the toss model, we select individual implied volatility because that gives you real P&L, and in and in one we turn on the wall surface and the CEV, and that gives you the real Greeks in one.
Okay. In one, it's got a new feature in the latest beta, something called sync, which is on by default. And what that does is it basically grabs, you know how like in option B you had the fact that the black dot, the Graham dot, didn't match up with the T+0, right? So what Andy has done, based on some requests that we've been asking him to do, and he actually got done really quickly, was to basically say, well, just grab that T+0 and push it up or down such that it then matches where the black dot should be, right? That way we get both an accurate T+0 and accurate projections moving up and down without us having to have a calculator out all the damn time and doing this stuff manually, right? So he did exactly that. So basically, by having that sync feature turned on, you're getting to see the accurate P&L, but the T+0 is now pushed up or down to match the black dot, right? So you're getting accurate Greeks and accurate P&L at the same time.
Okay, so then what's the use of toss to have either individual implied volatility or wall smile if one is going to do it for you both ways if you turn on the sync?
Right. It does do both, but up until one releases the full version, as in the non-beta product, then for now, my personal recommendation is to have Tosval Smile be the authoritative view of your Greeks. All right. So in other words, if Tosval Smile is telling me that the delta of my position is whatever 15, and then if I look at one tells me the delta of my position is 5, then today I would probably lean more to trusting that it's actually closer to 15 than it is to 5. Does that make sense? Right? So Tosval Smile is my authoritative view of my Greeks. It's what I trust the most today. When the full version of 1 comes out, I'll rerun all of my tests and then see which one is more accurate and decide then. But at this point, I've found that the Tosval Smile is a little bit more accurate than the current beta version of 1.
Okay, so I'm just turning that on right now.
Does that answer the questions? Anything else you guys want to know?
Yeah, John Bailey asked a question, or if you're a fan of the new 1 beta, are you referring to using it with CEV and all surface selected?
Yes, leave everything turned on.
Ron, how often are you getting updates from Andy to as the model progresses?
Really often, to the point that it's become funny because now it's the other way around. Like, he's the one that's bugging us to give him more data, right?
Oh,
So he's been extremely proactive. It's been great.
that's awesome.
And by the way, he welcomes it, right? So if you guys want to send him information on tests that you've run or maybe an inaccuracy that you think you may have found, he's all ears, right? He wants to know. The more data, the better.
Yeah, I just remember when I was on 1, it was that there was some kind of issue with end-of-day data when you can get it from your broker, but then you have to wait 24 hours before it's posted or something. And then I remember there was some issue around what you could display on the strikes. Like, you couldn't control what strikes it showed. It would just show like 5-point strikes, whether you wanted to see them or not.
Sure. Yeah, that's true. Yeah, there's no configuration there like you have in option B that you can say, you know, just show me the 25 strikes on SPX as an example, right? So if you don't want to see any of the others because you don't trade them. Yeah, that's not available, but, you know, it's not a big deal, in my opinion. Right? The most important thing is that you got accurate Greeks, right? That's where your money comes from.
Okay, so just one more question. So if I have the SPX road trip on, for example, my delta, my Greeks on using Tosval Smile are not matching up to 1 if I enable CEV Sync and Wall Smile.
Right. This is what I was saying before about 15 versus 5, right? So whatever Tosval Smile says to me, that is my authoritative view of my Greeks.
Okay.
Right? Now, if you want, you can do, you know, averages and all that kind of stuff. That's up to you, you know. But I would lean more towards the Tosval Smile for now.
How are the M3 trades going for everybody this month?
Good. I think the thing that people have to kind of watch out for is where we are, right? So we are kind of like on the edge, I think, right now. So if we break, you know, current very strong support levels in both SPX and RUT, you know, we could be in for some fun on the downside. But for now, the levels are holding. You know, like the 2000 level on SPX as an example.
We're in a position to move either way. Right, I don't think we'll hold here that long. Typically, when we move down in a base like this, you're either going to see a pretty good size move up, or we're going to break down.
Well, yeah, I don't know. I mean, I think we're kind of stuck in a in a volatile sideways chop, right? I mean, if you look back from where? From roughly October, mid-October. Okay, so from mid-October through to now, you know, we've basically been stuck between 2,000 and 2,100, right? Some pretty violent days up and down, but we're still stuck in that 100-point range.
Yeah,
right? It's been that way for the last, 2 months.
Yeah, I'm not referencing any price patterns. I'm just referencing just historical data. And you have a RSI at the as low as it is now. We typically see a lot more price movement than we do when it's higher. So I'm just referencing that just from a kind of quant perspective.
So I don't know. So I think for now we just kind of have to trade the charts, So if you're an SPX, you just set up a position that's going to cover your range between 2,000 and 2,100. I think that's the safest play, right? And then if we break those levels, then adapt.
The big question to me right now in the SPX is, have we been tracing out a big bull flag from the last high?
Maybe. You won't know until after the fact, right?
I mean, to me, that's what the pattern looks like. You had a strong rally from the August low, and then, we topped out, I guess it was like the end of October, beginning of November, and you have this kind of bull flag looking move down.
You do. The thing is, price action right now is under all of the major moving averages, right? So your bias, in theory, should probably be more to the downside than it is to the upside. If you get a bull flag with price still above the main moving averages, that's one thing, but this time we're on the other side of it, right? We also have a lower high. And of course, a lower high is required for a bull flag anyway, but a lower high, you could also switch that around and say, well, that's a head and shoulders top, right? So you've got plenty of technical analysis type of stuff that you could try and convince people that it's a bearish move is coming or a bullish move is coming. So and similarly, just like I said before, just looking at price action over the last 2.5 months, we've been stuck between 2,000 and 2,100. So I could say we're in a sideways chop, right? So I don't think there's much clarity right now in the charts. Things could go in any direction. We just need to be a little bit more careful, just to watch those ranges. And if we get a breakout, especially if it's the downside, it could drop pretty fast if it breaks 2,000. There's a bit of support at around the 1975 area, but if that doesn't hold, then we're probably back down to about 1900 before we find a little bit more support.
I definitely agree that the 2000 area is an important area since August. So it seems to be a big pivot area.
Hey, Andrew, you mind giving us a visual? A couple people were asking about that.
Yeah, sure. I mean, I'm just looking at this SPX chart. Can you see it?
Yep.
I mean, okay, you had this huge move down, very strong. You had a bounce up to, a little above the 2000 area, then a higher low, another rally, and, we went above there. It's interesting that, this move up was, fairly strong for a rally. We usually see these waterfalls down, and it usually takes longer to go back up. So this move up was pretty strong. And now here we are. We did make a lower high, and we came down again, bounced, came down again and bounced. So, you have a big zone here, around, let's say 2000 to 2015. where the market has pivoted back and forth. It's been either resistance or support. But, you know, you look at this move down, and so far you can make the argument that it's the beginning of another move down, you know, similar to what we saw here right before this waterfall. Or you could say, well, this is, you know, a bull flag, and we're going to have another move up. I think Ron is correct that, you know, the waters are very muddy right now. You can make a case for being bullish. You can make a case for being bearish. And that probably means this trading range is going to continue.
And the other thing is to also look, you know, look to the left, right? So if you look to the look at all the chop that we've had over the last year, somewhere between the 2000 to 2100 area. That's a crap load of upside resistance, right? That's another concern I have with the bull flag scenario, right? That's a lot of stuff to get through. That's humongous resistance. All right, and then just looking at concepts like lower lows and lower highs, if you look at the chart that you've got on your screen right now, you've basically got, well, depends if you want to count every single one of them, but, you know, either 2 or 3 lower highs, and now, you know, 2 lower lows as well, right? And the bounce that we're seeing now, we're barely getting back up through to the 8 exponential moving average. So you could say that this is just, you know, a little rally before the next stronger move down.
Right. You know, the question is, you know, was this rally just you know, a test of the old high before the market moves down? I mean, I can make the bullish case that, you know, here we broke down, and look how quickly we bounced, you know, back up. So,
yeah,
as I said, you know, it's really up in the air. I don't think you can state with a high degree of confidence that the market's going to go up or down right now. And I don't know if the picture is, you know, the picture's a lot more bearish in the Russell.
Yeah.
Yep.
So I don't know if, you know, that's a little hint about overall conditions.
Always hard to tell which one's leading.
Andrew, do you have an M3 on right now?
The only thing I have on right now is I put on a February road trip trade about a week and a half ago. And this is the trade in TOS. And this is a trade in option view. I put that trade on December 11th, and I paid 55 cents for the butterfly. It's kind of interesting too, because the commissions in the SPX are actually a little bit higher than what I'm used to in the Russell.
What broker are you using?
IB.
Yeah, I found they're about 29 cents higher. Wait, 4 versus 53.
You know, in the Russell, I'd probably be paying a little under $1 a contract, whereas here I'm paying, you know, well over. So that definitely goes along with what you just said. I know, are the commissions the same in the weeklies that are electronic? Because the monthlies are only traded on the floor, right?
That's a good question. I have to go through my my trades and see what I'm paying and which ones are which.
Yeah, this is the first time I've traded the SPX in a couple of years. And right now I'm looking at putting the trade on in the first week in March. And you can, as I told you before, someone is actually working a bid for that trade. They're trying to buy 6 of those butterflies for 65 cents. The 1930, 1980, 2020 in the first March. I think that butterfly is probably worth closer to 80 cents. I don't think they're going to get filled at 65.
Maybe they're just putting a flyer out there to
Right.
put a good price.
Yeah, unless the market moves.
The no M3s, any plans for M3s, or are you just taking a break from them?
To be honest, I got out of my December M3 so late that I missed January, and it's still a little early for February. So normally, I'd be putting on the February trade later this week. With the holiday, I think I'm going to take a look at things next week. But with all the problems in option view, I'm tempted to, just trade this SPX broken wing butterfly for a while.
Certainly is a low stress trade.
Yeah, as I said earlier, you really don't even need to worry about the Greeks in that trade, because the management can basically be done by where the market is in the 10. I don't think you have to know what the delta is, even to put on debit spreads, to the downside. I mean, it's nice to know, but it's not essential to managing the trade. I think what you need is just an accurate P&L.
Yeah. Hey, Andrew, the thing I'm troubled about that trade is I know that we typically could get into that bottom part of that tent about 50% of the time in a 30-day trade. So then the question becomes, at what point do you take it off for a winner, and then when do you adjust it in terms of adding the long verticals to it? Have you thought about that? Is there a particular target profit that you're looking for? Are you going to look to milk it for more, or what are your thoughts for
I think
the trader's choice?
I think that's the most discretionary part of the trade.
I do too. That's what I was trying to ask Tom earlier.
I think that's where having some sense of what's going on in the market has to come into play. Is the market near a support level that's likely to hold? In which case maybe you could hold off. Or did the market just break an important support level, and maybe you want to scramble to put on those debit spreads, or maybe even just take the trade off? Because again, I think it also depends on where you are in the cycle of the trade. If the market comes down later in the trade and you have a profit, and you don't want to play around, then take the profit and move on to the next trade. If it's early in the trade, you have a nice flat T+0 line, and maybe the market has a good chance of holding, then maybe put on the debit spreads, and if the market bounces back, take them off right away, before you lose too much money on them. That is definitely the most discretionary part of it, and it's probably the one that's going to give you the biggest headaches.
I think that's where the money's going to be made. The rest of it looks pretty straightforward.
I know Curtis and Paul Dammers have been trading a wider version of the same trade. And, that could be an alternative too that gives you a little more room. I think they've been doing 60 and 50-point wings. So, maybe that gives you a little more room before you have to adjust. I don't know how that works out compared to the 40 and 50. I guess you'd have to do some back testing.
Randy's been doing a trade he calls a white rhino, which uses that config in SPX, a 60 lower side wing and a 50 upper side wing.
I mean, are the adjustments similar?
It's kind of similar through to the standard rhino. So the upside, you do scale in on the upside, but you scale in with a broken wing instead of scaling in with controlling deltas on the upside. Instead of adding calendars out of the money, you add a slightly out of the money broken wing, typically a 50-40 or a 50-30.
I mean, that trade becomes a lot more complicated. The nice thing about Dan Harvey's trade is that, it is so simple. I put on, this trade earlier in the month, and the market was well above my long strikes, and I didn't want to do anything because it was so early in the trade. I know Dan mentioned that, if the market gets 30 points above your longs, then you want to start thinking about doing a reverse Harvey to raise that upper expiration line. But I think if it's early in the trade, the first few weeks, you probably want to wait and not be in a big rush to do that adjustment, because there is a good chance the market's going to come back down.
Yeah, like Dan said, he pretty much leaves it alone for the first month.
Right. Yeah, I think for the first 30 days, you're really only concerned about a sharp move down. And then your judgment comes into play as to what you do.
Yeah, maybe I can add that in that presentation, just taking a look at a little bit wider spread versus the standard 40-50.
Yeah, Curtis might be able to help you with that, because I know he's definitely been doing that trade.
Yeah, I'll get a hold of him. So before we wrap it up, there's still a few minutes left, but I was wondering, do you guys want to take a break next week with the kind of holidays and just meet again in January, or do you want to have a meeting next week? Consensus?
I don't know. It's probably going to be a pretty busy week in terms of people traveling and having things to do. So, might not be a bad idea to skip next week.
I would agree.
Yeah. Okay. So we'll just plan on meeting in 2 weeks then.
Hey, Tom, I have a question.
Sure.
And this is related to Andrew. I'm also doing these butterflies, the Dan Harvey butterflies. And liquidity can be very, very hard. And I was wondering, asking Andrew, you also, and Andrew and anyone who's participating, how much time do you give your order to be filled before you go to plan B? For me, plan B is I'll just leg the spread myself. What's been your experience there, especially in the Feb 5s, and Andrew, you were talking about the March 1s, which I'm working right now. What's your patience level there?
Well, again, how badly do you want to be filled? One of the nice things about this trade is the fact that you're out so far that you do have days to get into the trade. You can start looking at that trade, 70 something days and sit and wait for a day where the volatility is up and you know, the butterfly prices are a little depressed. You know, how
Yeah.
bad do you want to get into the trade?
I mean, you pointed that out. The days that we had the high volatility days, that's where you want to buy the butterflies because you get a better buy. And that's actually when I was filled, to my surprise. But otherwise, I mean, I'm just waiting there for days. And, you know, at some point, I realize it's a 70 or a 60-day trade. But at some point, I actually want to get something on. And have you legged into those spreads at all? Just buying the put vertical and then selling the corresponding put vertical against it, essentially making a butterfly. Have you gone that route?
I've never gone that route.
I have. I usually do that, but it's user preference. I mean, when I want to get into a trade, I basically I want to get into the trade in the same day. So I only wait about 2 hours before I keep adjusting my prices.
Okay. Yeah.
I mean, if you're you know, halfway decent at market analysis, you can leg into that and, you know, watch something like a 5-minute chart. And, you know, if it looks like, you know, it's going to be a trading range day, you know, when the market is up near the top of the trading range, you know, put one leg on, and when the market's down near the bottom, put the other leg on. I don't have any experience doing that, but you know, it's certainly a possibility.
Yeah, I leg into a lot of my trades, and over time, the history has been, you know, basically you win some and you lose some, so it's a scratch over time. In this particular long-dated trade, I have not, because I got filled on a high vol days, which makes me very happy. In fact, I'll tell you, I got filled. Is it February 5th, December 15th and 16th? Those are high vol days into February, the monthly expiration. I bought the 1990s, sold the 1950s, and I bought the 1900 puts. Granted, I got filled, and two of those strikes, the 1900 and 1950s, that's usually where the big players play in the even strikes before, you know, the days to expiration comes in. But, you know, I got lucky because of the high vol day. I got good prices. We all want good prices, of course. But now I'm working spreads. I'm not getting filled, and it's, you know, frustrating. So I want to know what the general experience is. But that might be something to talk to Dan Harvey about. I know Dan's very laid back, and he's not really in a hurry. But like someone like Curtis, I'd like to know what his experience has been.
Bowden, can you hear me okay? Just a quick sound check.
Yeah.
Yep. I could offer this. You always got the option of filling a symmetrical fly, which you're going to have no delta risk when you get that on, and then work on the rolling back the upper put by way of a vertical. That's what I've been doing.
Mm-hmm. Yeah. The good thing about these butterflies is that the verticals don't really move that much during the day because they're so far out. And you take one leg and you give yourself, you know, when you give yourself 5, 10, maybe 20 cents, I mean, you definitely want to be filled by the end of the day for sure, right?
Yeah, sure. I would just rather not have the interim delta exposure of a vertical, either a credit or a debit spread.
Right.
While I'm trying to, I agree with you. Every time I've tried to get cute and time it intraday, I generally end up coming off bruised, you know. So for me, the way to go with this is a symmetrical fly and then roll down the upper put.
Yeah, that's a thought. I appreciate that. Thank you. That's a good idea.
No worries.
I think that in this trade, price is probably a little more important too, because, you know, you're talking about, you know, a price of less than $1, hopefully. So, you know, every nickel becomes more important, you know, as opposed to, you know, bearish butterfly or an M3 where you're talking about, you know, an $8 or $9 or $10 trade where a nickel is inconsequential.
Mm-hmm.
So I think you do want to fight for price in this trade as much as possible.
You definitely do, but you also want to get it in early because as your days to expiration are reduced, that butterfly the price will actually increase unless the market just completely gets away from you.
Right. So I actually backtested Dan Harvey's trade from 2011 onwards, and I've realized that if the butterfly costs more than $1.20 to $1.25, it's really not worth putting on, just because if there's a slow grinding up market, it gets really difficult to raise the upper longs so that you can raise the tent. I always land up losing about $200 on a 5-lot butterfly if the market is just moving upwards. If there's a pullback, then it's fine. But, there were days in 2012 and 2013 where this trade didn't really work out for me.
Mm-hmm. Yeah. I think when you go out, you have to, at least my experience, I will almost, if I'm buying a 6-lot or a 5-lot, I will almost always roll some of my strikes in. In other words, I'll sell the condor just to reduce to me, price is everything. The cheaper, the better, and I will reduce my costs, and I'd rather go in and do it again. Anyway, it's food for thought.
I mean, that definitely works. I mean, there was no way in 2012 and 2013 you could do a 40 or a 50 lot butterfly. I had to bring it down to 20 and 30 lots. And I mean, in the sense that 20 width on the upper side and 30 width on the lower side, just because I had to reduce the cost basis of the butterfly. Sometimes I had to break up my short strikes about 5 points apart just to get within the $1.20. But anything above $1.20, as I mentioned, it gets really difficult to manage if it's a slow grinding up market.
Yeah, I mean, I'm working condors now to sell for $1.50 that I've been seeing for days, and at some point I'll just put it on and kind of hope for the best and keep managing as best you can.
All right. Well, looks like we're about at a good place to stop. So with that, let's call this meeting over, and then we'll regroup at the first day next year. And I hope everybody has a good holiday, a good New Year, and good trading.
Same to you, Tom. See you guys in 2 weeks.
All right. We'll see you. Bye.
Thanks.